So I'm going to start off with a disclaimer of this is just general advice and information, and it is not personal to each person will have a personal tax situation. So it's not aimed at anyone personally, so you want to make sure. So that's just my plan, and you're going to see my disclaimer throughout the session. But let me share with you some information. So hopefully you can see the PowerPoint. And we're going to talk about, should I change my business structure? And we're going to primarily be talking about pass-through entities. And I'm going to explain to you what a pass-through entity is. So again, this is my disclaimer. I'm not giving anyone any personal financial advice. This is only for information. And you want to talk to your financial planners, your accountant, anyone else, once you view this, once we are finished with this webinar. So we're going to talk about business structures, LLCs, corporations, S corporations, partnership, and sole proprietors. We're going to discuss what net income is, what makes up net income, what are tax deductions, tax savings, pass-through entities, and other benefits of having a pass-through entity. So if you have questions during this, please email them to Carolyn, thebottomlineinc.net@gmail.com. And I'm going to take questions at the end, but I just want to kind of go through some of this information first. So again, I'm going to do my disclaimer. This is going to pop up here every so often. So when we talk about a business entity, the definition of what a business entity, it's a corporation, association, partnership, limited liability company, limited liability partnerships, general partnerships, and any other legal entity. You can go into having co-ops. There's all kinds of membership businesses. For our purposes today, we're going to stick with these 5. Sole proprietorship, which is, the easiest, is one person. It can be a husband and wife or 2 legally married spouses can have a sole proprietor. Partnership is 2 or more people. Limited liability corporation can be 1 or more. Corporation can be 1 or more, and an S corp can be 1 or more people. Starting with a sole proprietor, it's the simplest business entity. Anybody can set this up. You can be in business today. You can use your social security number as your tax identification number. There's no special registrations. And in the state of Pennsylvania, if you use your own name, you don't even need to register a fictitious name. So a sole proprietor is the easiest, and you can say you're in business today. Partnerships, similar to sole proprietor, except you have 1 or more people. You can't have a partnership with a single owner. The issue with partnerships is sometimes if one of the owners wants out of the business, it can put the whole business out of business. So there's different kinds of partnerships. You can have a general partnership and a limited partnership. If you're a general partner, you're a part of the operations of that day-to-day business. Limited partnership, you're only limited in that partnership up until your investment. And you have limited input on what happens in the business. An LLC can be you can be a sole member LLC. It's a limited liability company. That's paperwork. There's operates very similar to a partnership or a sole proprietorship. So a limited liability can have multiple members, or it can have a sole member. Unlike a partnership, you need 2 or more people. A C corporation, as every business, if you're going into a corporation structure, you incorporate. From that structure, you then elect how to be treated tax-wise. You can elect to be treated as an S corporation, or you can elect to be treated as a nonprofit corporation, or a co-op, or different other business entities. But primarily, once you incorporate, you become a C corporation. And a C corporation is totally a separate entity. I always say it's like having a child. It becomes its own entity. An S corporation is we're just electing to be treated as a small business corporation. There's some limits to that. The numbers of members that you can have, the stockholders, not members, they're actually stockholders. You're limited to 35 stockholders, husband and wife, married spouses are considered one. The S corporate's profits are taxed at each member's personal level versus at a corporate level. Right now, our corporate tax level is 21%. It's a flat tax, which in previous years, and that was one of the, when President Trump was in office, he made a flat tax in corporate levels at 21%. Prior corporate tax always started at 30%. So we have a lower of corporate tax, which is why some people are choosing C corporations versus S, because depending on their income, their personal level of income could be taxed at 25, 35% versus a 21 flat tax, 21% corporate flat tax. But the S corporation gets us each taxed at our personal levels. And there's no corporate tax on an S corporation. The other controversy with a C corporation is the corporation pays tax on the net profit. And then if the individual shareholders receive a dividend, they again have to pay tax at their personal level. So that's where the controversy of double taxation on a C corporation comes in. Unlike an S corporation, the corporation does not pay tax. Only the individual shareholders pay tax on their dividends. They're part of the income. So we're going to talk for the most part about what a pass-through entity is and partnerships, S corps, LLCs. I'm always prejudiced to corporations, whether they're C or S corporations. LLCs, Pennsylvania didn't quite recognize them for a while. In some ways in Pennsylvania, you still have to do as much paperwork to get an LLC as you do a corporation. So there's not, other states it's different, but I'm going to talk primarily about Pennsylvania. Partnerships, again, there's drawbacks, but it is considered a pass-through entity. Again, a partnership is not taxed. Each of the individual owners of that partnership are taxed at their tax rate. So here's a graphic of this. As a company pays no tax, the profit and loss goes to the owners. The other thing is if there's a loss on you will receive a K1 from your partnership, from your S corporation. If you have an LLC, you can elect to have it treated as an S corp. So you can have an LLC that is taxed as a pass-through, or you can have an LLC if you're a sole member, the only owner, you can report it and be a sole proprietor and report it on your own tax return on a Schedule C, like a sole proprietor. But when we talk about tax-through entities, and we're going to go in, I'm going to show you the tax savings. There's good, the pass-through entities has some tax savings and there's some benefits of being a pass-through entity. And why, if you are an LLC, you can just elect to be treated as an S corporation so that the company doesn't pay tax, but each owner would pay tax on that business. So things you get as an S corp, and I'm going to use S corp because if you take an LLC and you elect to be treated as an S corp, you're going to file 1120S, which is a small business corporation tax return. Same with if you incorporate and you elect to be an S corp for tax purposes. So you get some asset protection. When you create an S corporation, again, you're creating an entity onto itself. It's another business. As a sole proprietor, you are your business, you're using your own social security number that's very connected. You have additional credibility because now you've created a company. It's just not Wally Moyer accountant, it's now the bottom line. So there's some accountability. The bottom line has its own credit scores, its own EIN, its own tax identification number. There's less risk of audit. So actually the IRS has come in and said, hey, look, most of these tax returns that are done are more complex than a Schedule C for a sole proprietor. So there's more information that you have to give the IRS when you're filing as a corporation, an S corporation. So you have a less risk of audit because more is being disclosed right up front. And what we're going to focus on today is the tax savings and the corporate benefits. You know, and those are the two areas that you were invited to this workshop because I feel like your business could really benefit from these two areas. So we want to talk about net income, and I'm going to talk about net income a lot. And the net income is and people get confused when you say, what's your income? And if you're a small subcontractor and you receive all 1099 income, and your 1099 income is $100,000, you can say, oh, my income's $100,000. But if you have $20,000 of expenses, and we're talking about business expenses, and they're costs that you incur in the ordinary course of your business. So if your total revenue is $100,000, you have $20,000 in expenses, you only have $80,000 of net income. So that's what we're going to talk about a lot is net income. So, and when we talk about expenses, we want ordinary expenses. And we're talking about business expenses and other people hear write-offs. Oh, take me out to lunch, you can write this off. The car dealer tells you, oh, lease your car, you can write it off. Some of that's true and some of it's not true. If you are a house painter and you buy a Lamborghini, you cannot write that Lamborghini off because do you use that in a normal course of business? If you're a house painter and you buy a Mercedes van, you might use that in a normal course of business. So that could be 100% write-off because you only can use that van with all your painting equipment in it. So really think about your business expenses as, you know, common sense. Is this normal course of business? The other thing you want to think about is all your expenditures. Hey, did I do this to create business? So you might join them in some memberships, as in cricket clubs and certain memberships aren't deductible. Other memberships, if you're a member of a business organization, it is deductible. So you want to think, is this a normal part of my business? Your utilities, if you rent space, if you have electric and gas. Now, if you have office and home, that is a normal course of business. That's an expense. So it's basically, you know, any expenses that you're going to spend to make money. The other good, as a sole proprietor even, and as a pass-through entity, if your children or your spouse works in the business and it's your business, there is income that you can then give to, now your children have to be of legal age to work in whatever state you're in, but you can spend, you can give them income on a W-2, get a tax write-off, and they are not taxed because of the standard deduction. You also don't have to pay FICA or Medicare tax on your family members. So that's one of the other tax savings. If you do have a business, if your spouse or your children help you, and I know growing up as a kid, my parents had a business, and once I turned 15, we always had W-2s. It was a family business. We all had to work. So, you know, oftentimes, you know, and you have to prove that your children are doing some kind of function in the business. What are they doing? How much are you paying them? And you want to pay them on a regular basis. So your business expenses are write-offs you get normally, but as a pass-through entity, unlike a sole proprietor, you get some extra ones. If you're a subchapter S, you can deduct your health insurance as a business expense. Now, the health insurance does get included as a subchapter S corporation. You have to put yourself on payroll. You need to take a reasonable salary. So if you were a house paying a reasonable salary, depending on the income, what would that be? And then any health insurance, would it be included in your W-2 as income? But the business gets to write it off. You get retirement funds and HSA, and we're going to talk a little bit about retirement and HSAs as well as other benefits. And you get to write off the expense of your own salary from the business. So as we go through this, again, if you have questions, please be emailing them to Carolyn. And then when we're done here, I'm going to come back and take a look at those questions. So a pass-through entity, it's just basically that the income, the business avoids any tax, any type of corporate tax. Because corporate tax used to be at 30%, people's personal taxes were much less. So if your income is lower, you would want to be taxed as a pass-through entity. And if you own a business with multiple shareholders, again, an S corporation, you have 35 shareholders, all must be United States citizens. And, each owner then is only taxed on their income, their portion of income, and at their own tax rate. So if you have one owner who makes, $100,000 on W-2 and is making $20,000 on the K-1 from the business, they're taxed at their rate. Where if you have someone who's only working in the business, is only making $30,000 from the business, they're taxed on their rate, which would be much less. The other money that you're going to save is it can go back into your business for operations and growth. So again, my disclaimer, this is education information only, but set up an appointment. If there's stuff you need to talk about personally, please set up an appointment and we can go over that individually. So these are the parts of taxes that we pay. Federal income tax, state income tax, self-employment tax, which is equal to the FICA and Medicare tax. So if you're an employee, you pay 6.2% of FICA and you pay 1.45% of Medicare. If you add those together, 7.65, and multiply by 2, because the employee pays half and the employer has to pay half. So it's 15.3%. And that's your self-employment tax rate is 15.3. And the big thing about a pass-through entity, the big savings is going to be on self-employment tax. So you'll always have capital gains, property tax, sales tax, local taxes. Lots of taxes that we have to pay. So when you take a net income, again, our net income is the gross minus the expenses, we get net income. And as a pass-through entity, a reasonable salary would be $48,000. The business profit is now $72,000. So normally on a business, if you're a sole proprietor and you netted $120,000, you would pay self-employment tax, which would be $18,360. As an employee, you're only paying self-employment tax on the $48,000 that you take. The other $72,000 comes as income, and it's just paid on income tax. So right there, and this is, a reasonable amount of money is $120,000 of net income. You can save $11,016 roughly for tax savings. Most of these tax rates are 2021 tax rate. So again, your net income at $120,000 as a sole proprietor you're paying self-employment tax. That's not it. So you always pay income tax on 120, but you pay this self-employment tax of $18,360. If you have net income of 120,000, you're only paying the self-employment tax, the FICA Medicare piece of $7,344. So it's huge saving from a sole proprietor to an S corp. Now the FICA tax ends at 147,000 for 2022. So your max FICA that you're going to pay is $9,114. Medicare tax is on all of your income that you take as either as self-employment or as payroll. So now I'm going to talk about some plans for benefit retirements. Excuse me. So here we're comparing self-employment retirement plan contributions. If you made 100,000 of net income and you're over 50, you always get this extra recap of retirement. But if you're in a traditional IRA, you get to contribute. This is 2021, it's a little higher this year. You can contribute 7,000 is your max traditional IRA. If you're in a SEP IRA is 25% of your net income. And then it is max, but it's 25% of net income. So if you're $100,000 is your net income, you can put in $25,000. Solo 401k. Now, all of these plans, you want to talk to your financial advisor. I am not a financial advisor. I do not do investments. I do not sell investments. I only work for my client. I am their tax accountant. I will advise, but I only make money when my clients pay me. So these are funds that Merrill Lynch, Solomon Smith, there's lots of E-Trade. You can TD Ameritrade. You can go on and open these accounts, simple IRAs. On your own. You can also do what's called a simple IRA, which maxes out at 13,000. But these are our basic IRAs for self-employed individuals. So here you have retirement contribution simplified. So if we take our gross income of 100,000, we take our expenses out and we net 80,000 of net income. Now on our W-2, our payroll as an S corporation, pay us serenity, we're going to take 32,000 as salary. So now we're only paying self-employment tax on 32,000, not on the 80. And we're going to take 48,000 as profit. The salary always has to be reasonable. There's been cases where somebody will net, 80,000 and say, "Oh, I only took 10,000 as salary." So you pay much less on your self-employment tax. That's not a reasonable salary, unless it's a very part-time job and you can prove that, hey, look, I only work 3 hours a week in this business. But you want to basically make sure that W-2 salary, that's a real red flag for the IRS, is reasonable. So if someone's a house painter, is 32,000 a year reasonable salary? And a lot of times you have to look at the net income, you look at the profit, and you look at what do people in that industry get paid. So on a SEP IRA, because the max, the 32,000 was the W-2 wages, they can put in 25% of that 8,000 max into a SEP IRA. When you go into a solo 401k, the max contribution you can save for retirement is 28,500. The 8,000 is the max allowed employer contribution. So now you have an employer contribution, you have another write-off. And then the employee, and you can be the employer and the employee if you're a sole owned corporation, So you can then, in a 401, a solo 401k, you can contribute $20,500 as an employee contribution. Which then, if you take that 20,000 off of your salary, you're now only taxed on 12 because it's the deferred compensation. And then if you're over 50, right now you can add 7,000. This was last year's numbers. So if we go bigger and you're making 450,000 of gross income, you have expenses of 50,000. You have a net income of 400. Again, you know, your net income, you have to take a salary, and all your retirement's based on your salary. And then you have a profit of 246,000. So again, you're only paying on your first 147,000 is when you pay FICA. And you know, on 154,000, you would have to pay Medicare and Medicare is 3%, versus the FICA 6.2, or it's, you know, 13.4 for the employer. So your max contribution here is, as a SEP IRA, would be 38,500. Your contribution in a solo 401k, you can then max it out at 59,000. So there is another retirement. If your income is supporting that, or you're older, you may want to be in a defined benefit plan. And these, again, are done through a financial planner, advisor. There's share builder 401ks. There's a couple of different organizations I've worked with. There's 401k in a box. There's a Merrill Lynch. Any of your Vanguards, any of your financial planners should have these financial instruments. So a defined benefit pension plan will significantly save you and reduce your taxes. Where an IRA and a SEP IRA are very limited, with being self-employed, you can contribute much more to a defined benefit plan. I'm not even going to go into the calculations. They're fairly, it's a lot of calculations that we're just not going to do. So with a defined, and there's a 401k in a box, you can go there and use their calculator. And a defined benefit plan allows you to have a solo 401k at the same time, which again, in that scenario, on a 401k, you get to do the employer and the employee contributions. So once you decide you want to be a pass-through entity, what, you know, the one thing you want to find is a name. If you don't have a fictitious name, you want to have a fictitious name. You can use your own name, and you don't have to register it as a fictitious name. But again, we're talking about credibility and how, unless you're an artist or some kind of other writer, we've incorporated writers because their name is the only thing that people know them by. So everybody's going to have different individual needs, is why I'm just talking in general today. But you're going to need to pick a name, fictitious name, in whatever state you're going to have to incorporate. And then we're going to have to file the S election. The IRS makes you elect the S status. You have to do it before the 15th of March in the year, because it's on a calendar year for an S corporation. If you're not within that 15th of March, there is some exclusions, and you can ask the IRS to, hey, can you please let me be an S corporation because I didn't file on time. So there is some exclusion. The other thing, so you have to file and you have to physically make an election with the IRS. And the IRS has to say, yep, you can be an S corporation. The next thing you have to do is you have to be on payroll. So you can pay yourself quarterly, but you have to make quarterly payroll deposits as if there was an employee. We use a payroll service. It's much cheaper. I'll help you set up with that payroll service. We can do that for you each quarterly, or if you decide to take, hey, I'm just going to take $2,500 every month or $5,000 every month, whatever that is, we can make that as well. You can also go in and make adjustments and saying, hey, this month I want more, this month I want less. If you have a cyclical business, you know, if you're doing landscaping in the winter, you may not take as much money as you did in the summer when you made more money. And then you have to choose your other benefits. And when choosing these benefits for year end, we always have to make sure that if you're a subchapter S and you're paying your health insurance through the business, we have to make sure that that's in your W-2. So there's some little tweaks at year end that you'd always want. Being a subchapter S corporation does require more bookkeeping, does require a bit more diligence. If you don't take payroll as a subchapter S, the IRS is going to frown upon you. You cannot 1099 yourself. You can 1099 yourself if you rent space from yourself, if you own another building and you rent space to the business. There's other reasons you can give yourself a 1099, but your primary income coming from that business should be on a W-2, again, at a reasonable salary. So most of you know where to schedule an appointment. If you want to schedule an appointment, and with us, the website, that's where you can schedule appointments. And we can talk about the individual needs of whether you should be an S corp or not. And then we're going to do questions. So I'm going to pause for a minute, and Carolyn's going to email me questions that you have inquired about. So I'm going to look at questions here. Just give me 1 second. So, okay. So the questions are about retirement. Can you contribute to a 401k and a SEP IRA? You can contribute to a defined benefit, the self-employed defined benefit, and a 401k, but not to a SEP IRA. So just be clear. So you can have a defined benefit plan and contribute to that and a 401k, solo 401k, but you cannot contribute to a 401k and a SEP IRA. Okay, okay, again, the FICA, we have a question on FICA. So your self-employment tax is made up of two parts. It's FICA and Medicare. Just like as an employee, you pay Social Security tax. And it's partly FICA and Medicare. And they split this up a while ago, where FICA is 6.2% for the employee and 6.2% for the employer. Now, if you're self-employed, that self-employment tax adds them together. The other is the Medicare taxes, which is 1.45 for the employee, 1.45 for the employer. Self-employment tax adds them together. So we're adding together the 2.9% Medicare and the 13.4, which gives us 15.3% is your self-employment tax. So that's how we figure self-employment tax. Normally, as an employee, your business pays half, your employer. Wait. Now, when we talk about net income, and we're talking about income tax. So when you file a federal tax return and you're a sole proprietor, you're paying self-employment tax. And that's where we go back to that example of the guy paying self-employment tax on 120,000 versus paying it on a lesser amount, a reasonable salary. You're still going to pay that 15.3%, but it's a reasonable salary. What happens when you do that on a subchapter S, you get a K1, and that income, then you'll have a W-2 and you'll have a K1. The K1 income is only subject to income tax. So you're only subject to part of your income, this reasonable salary, to the 15.3%. So that's the big savings tax-wise, and why I think everybody, and I kind of encourage everybody who makes, you know, even if you're, I just incorporate someone who annually makes around 45, 50,000 a year. The big savings is to take 30,000 and pay self-employment and the other 20,000. You know, when your income goes up over 100,000, you can see much more. Like our example was, you're saving $11,000 tax dollars. And, you know, in $11,000, I'm sure there's a charity we could donate to. And this is just stuff that's legal. I mean, we're not advising, this is stuff that's been out there. Okay. Okay, so the other questions here. So someone formed an LLC years ago, but never did anything with it. What has that LLC should be put out of existence, or you can read. The problem with bringing that into existence is you're going to have to file tax returns for all those years, even if the tax returns are zero. And depending how the LLC, and this is again a question that I'd have to answer personally, because depending how it was set up, we'd have to see how it was set up, what state. So I would say if you're starting a new business, start clean and fresh today. So can you take some of the profit? Well, every business, the profits are 100% taxable. It's just, I don't care if you're an S Corp, a C Corp, a sole proprietor, a partnership, whatever you make as net income profit, it is taxable. Now it depends on, you know, now if you want to put it back into business, that's fine. You've already paid tax on it. So you don't pay tax twice on it, but you can't keep money in the business and not pay tax on it. So reasonable salary, that's always a big question. And a lot of times we look at reasonable salary of what other people in your industry do. You know, is this a reasonable salary? If you're a psychiatrist, you're not getting paid $15 an hour. So it's a reasonable salary if you also record the hours you work and say, hey, I'm only doing this part-time. So we can prove that that's a reasonable salary. So for most industries, and I'm not gonna, don't quote me because I can't think off the top of my head where, but there are, you can Google it and say, what's the reasonable salary for a psychiatrist, or what's the reasonable salary for a house painter? So there's always what's the reasonable salary. So the other things with corporations, what happens when you die was a question somebody gave me. It's an ongoing entity. Once you create a corporation, and if you think about larger corporations, IBM, Pico, you know, utility companies, they go on and becomes an asset to your heirs. So your corporation would then become a part of your estate. So it's an ongoing entity. I'm not seeing any other questions. I think I got most of them, but if I didn't, I promised people I keep you about 45 minutes, so I'm keeping to that. But you know, set up a time if you think. I mean, I wanted my clients who have small businesses to be a part of this discussion, because it's going to save you tax dollars, and that's my job. So instead of when each one of you figure one session recorded, I can get it, get the message out. And if it's something you want to pursue, schedule appointment with me. We can talk over your personal issues. And thank you guys for coming, and happy holidays.